So payroll liabilities are another current liability. So that's just what we need to pay to our employees. So we're going to learn the journal entries for reporting, like the actual payroll, like the checks we're cutting to our employees, as well as the taxes, the payroll taxes. Now, this isn't a tax class and this isn't payroll. I don't teach tax because there's just too much. I'm not a tax accountant and you have to stay on top of that every year. But I do teach payroll, and we're not going to go into in this class like how we look at payroll tax liabilities. You know, you're going to learn they're going to give you like the tax payroll percentage, like federal income tax withholding is 20%. You know, in the real world and in payroll, we actually learn how to calculate federal income tax withholding, looking at those lovely payroll tax tables and everything like that. But we're not doing that. This isn't payroll. But it's important to understand the liabilities that are associated with having employees. So many liabilities, right? Remember Bob driving that, you know, that whatever, forklift, that's what it was. What was Bob driving? Bob's a liability in and of himself. But we're going to look at payroll, okay? So payroll, of course, is important because those payroll taxes and the amount of payroll really reduces our income. And then payroll is subject to federal and state regulations. Again, we're not going to go into all of those in this class. You'll just have a basic understanding. And then, of course, it's important that we pay payroll timely and accurately if you want to keep employees. Shocking, right? Oops, it didn't advance. Okay. And we usually have different terminology for different types of wages that we pay or different types of payroll. Salary is usually when we talk about management or even administrative. A salary is usually like a monthly amount. You get a yearly salary, you know, split it into months or whatnot. So it's like a flat, you know, oh, I make $45,000 a year, I make 35 or whatever. Okay, so wages are usually when it's an hourly basis. So that's the only difference in the terminology, but it's all payroll. It's all payroll expense. Okay, and of course, those salaries or wages could be increased by bonuses, commissions, profit sharing, all that fun stuff. Again, we're not going to get into that. Companies, of course, do have to follow federal standards, the Fair Labor Standards Act or the Federal Wage and Hour Law. Basically, that just requires that we pay a minimum wage. Minimum wage right now is what, $7.25? Yeah. And employees that are hourly would accumulate over time. So anything worked over 40 hours in a week, we would have to pay them time and a half, okay? Again, you're not going to have to worry about calculating that. They're kind of talking about regular pay and overtime rate. We're not going to calculate that, but it's just kind of good understanding. But what I want to focus on are the journal entries for payroll and the payroll liabilities. So the total earnings of an employee is gross pay. So that's what you never see, right? The gross pay is what you don't see. That's before we take out everything. So gross pay is like your base salary, right? Like your yearly salary is your gross pay. Net pay is what you actually get in your paycheck, okay? So net pay is gross pay minus all the tax liabilities and any other stuff that's withheld from your paycheck. Okay, so I think of an actual like fishing net or something, you know, it's like the net pay is what is actually in the net, what you get, okay? So net pay is the check we actually cut to the employee. Gross pay is what they earn before all of the fund deductions. So deductions we're going to look at, well, we have federal income taxes. We're in Oklahoma. Oklahoma has a state income tax, so that gets withheld as well. Some places have local income taxes, like city taxes that are withheld from payment. We don't have that. You have medical insurance, pension contributions. There's other ones too. You know, we have, like, we'll talk a little bit about them as we get there. But those are the big ones. So really what you need to know is that the employer is responsible for withholding all of those federal and state taxes, you know, federal income contributions, or I'm sorry, Federal Insurance Contribution Act, FICA. You've probably heard of FICA. So that's your Social Security and Medicare tax that gets withheld from every employee's paycheck. So the employer takes the gross pay, calculates federal income withholding, state income, FICA, Social Security, FICA, Medicare, whatever else, and the employer keeps a hold of all of those amounts, and the employer is the one that's responsible for sending that money to, you know, the IRS or the Social Security office or wherever. Okay. Each employee fills out a W-4, which kind of helps calculate, you know, how much federal income tax is withheld. You know, it's when you say you're single or married and how many people are dependent upon you, and that factors into how taxes are calculated. Again, we're not going to go into that. But you probably, if you've ever had a job that paid you wages that were taxed, you know, withheld tax from them, then you've probably filled out a W-4. You may have filled out a lot of W-4s. So that's just an example. And again, we're not really concerned with that. So that's for federal income tax and state income tax. That's when that W-4 comes into play. FICA, again, federal, it stands for Federal Insurance Contributions Act. It's where, you know, every person that is a taxpayer has to pay into both Social Security and Medicare system. Whether we ever see it or not, we have to pay into it, right? So that is two different systems. We have Social Security and Medicare, okay? They're doing, these are not accurate withholding rates, just so you know. They're just giving us some to go on. Social Security, the actual rate is 6.2%, so I don't know why they don't just do it. It's been the same for years. And Medicare is 1.45%. But to simplify, they made it easier. The calculations are all the same, so it really doesn't matter what the amount is. So we're going to withhold Social Security at 6% on all earnings and Medicare at 1.5%. Okay, so that gets subtracted from that gross pay, calculated off of gross pay. So in there, they're just showing you if John T. McGrath's earnings for the week were $1,462, he would owe 6% in Social Security tax, or $87.72, and 1.5% in Medicare, or $109.65. So those are pretty easy calculations. Okay, there's a lot more to FICA. There's wage limits and all kinds of stuff, but that's what you need to know right now. So every employee, we're going to take out federal and state income tax, both FICA, Social Security, and FICA Medicare. After that, a lot of it is like optional deductions, okay? So it could be your 401k or 403b that you're contributing to gets taken out of your paycheck. And these can be both non-tax or taxable contributions. It could be health insurance. You know, if your employer offers health insurance and they usually are the ones that take it out of your check and pay it to like Blue Cross Blue Shield or whatever. It could be life insurance. There's all kinds of what we call supplemental withholdings. It could be a garnishment, you know, when you owe and the state or the federal government sues you and then withholds money from your paycheck to pay back a debt. You know, it could be for like child care, you know, child support, or like past due taxes and stuff like that. You could have other things like charitable donations taken out. You could have money withheld and put into your savings account. There's lots of different optional. We call a lot of that, like if you've heard the term cafeteria plan, that or a flex plan, like we have what we call an FSA, a flexible spending account here. So I have money taken out every month that I get on a card at the beginning of the year that I can spend for like doctor appointments and prescription medicine and stuff like that. So that comes out of my paycheck, but it's my money. You know, they just put it on a card and then it's tax deductible. So I don't get taxed on the money that I contribute. So it lowers my taxable income. So there's lots of options. When I was paying daycare, thank goodness I don't have to pay right now, that I was having taken out of my paycheck as well, you know, pre-tax, and then paying that, you know, on my own. And they were reimbursing me. So there's lots of options. You know, I always tell, like, I won't get on my soapbox about, you know, all of that. That's a personal finance thing. But just know, you know, I always tell students, just when you're evaluating like job opportunities, always consider those you know, like perks, the benefits, fringe benefits, because like people always ask me, for instance, like, why do you teach? You don't make much money. It's true, you know, I could make more working in accounting in the field, but my benefits are like 50% of my salary every year. So I get, well, if you think about it, I really work like 8 months out of the year. I teach in the summer, but it's extra pay. And then, you know, I still get sick leave. I have a lot of sick leave that I don't use. I still get like 40 hours a year of discretionary leave, which I can use over 8 months, which is quite a bit then. I get paid retirement. When I retire, I get 75% of an average of 3 years salary. You know, I get my health insurance paid for, my vision, my dental is all paid for by the college. And they also contribute, I think, 1.5% to a 403B plan. So
that's a pretty good plan.
It really is. So a 403B is really just the nonprofit version of a 401k. So if you work at a corporation that's a for-profit, you would have options to contribute to a 401k retirement plan. So in a nonprofit, they just call it a 403B, but it works the same. So I'm putting money in and they're matching it, and it's going into, you know, to like stock market accounts and stuff like that. And so, you know, I have that option. I can't remember who even oversees ours. I get the emails and I look at it, but I just let it sit. So that's what I tell people, you know, the benefits of my job are good, because right now in our current market, our current climate, it's really hard to even find employers that pay health benefits. They don't pay for my dependents, they pay for me. So if I were to put my kids on my health plan, I'd have to pay. But like my husband pays out of pocket for even his health care. You know, it's a smaller amount, but he still has to pay. So that's the only thing I'll say about that, you know, and there's lots of optional withholdings. But I always tell students, if an employer is matching funds in a 401k or a 403b, always contribute at least the match, because it's free money that they're contributing. So if they say they'll match up to 3%, put 3% in, and they put 3% in, and you're building retirement funds, okay? That's all I'll say. So as far as in computing employee net pay, we're going to take their gross amount, you know, what their annual salary is and all of that, and then take out all of the deductions to get net pay or take-home pay. So let's look at John T. McGrath. He authorized weekly deductions of $20 for retirement savings and $5 to United Fund contributions. So that's just a charitable donation. So we assume that $257.95 is withheld for federal income tax, and they're showing us all of his deductions. So his gross earnings for the week were $1,462. We calculated Social Security tax at 6% of that. They showed that on the previous slide. Medicare was 1.45%, so we did that calculation. They gave us the federal income tax. They told us he's putting $20 into retirement and $5 into a charitable donation. So we added everything that's being taken out of his paycheck, which was $392.60. So we will write a check to John T. McGrath for $1,069.40. That's his net pay or his take-home pay. It's always depressing when you see all of it, right? Like, where did my money go? Okay, so that's everything we would want to journalize. Okay. That's the employee's responsibility. All of that's coming out of his or her paycheck, right? He's having to pay federal, state income tax, FICA, Social Security, Medicare, and any other deductions. The employer also has what we call payroll tax liabilities. So it costs us money beyond just paying them a salary. It costs us money to keep employees. We have to pay FICA taxes on each employee. You know, they were contributing 6% of Social Security and 1.5% of Medicare. The employer also pays 6% Social Security and 1.5% Medicare. So the employer pays FICA, and the employer is the one responsible for paying unemployment. Okay, the employee doesn't have to pay into unemployment fund. So there's a federal unemployment and a state. So we have what we call FUTA and SUTA, federal unemployment and state. The state unemployment is actually the agency that's responsible for paying unemployment funds. So we generally pay a lot more into state unemployment. The federal unemployment payment or program is really to regulate and set rules and laws and oversee the state. So we're going to see more contributions going into state unemployment than into federal. So the employer pays these taxes, these withholdings, okay? So in there it kind of shows you on a nice slide, the employee, Social Security, Medicare, federal withholding, those are all required, and then we know we have optional ones as well. And the employer has to pay Social Security, Medicare, federal unemployment, and state unemployment. And all of that goes to the government. So payroll liabilities are normally recorded at the end of each payroll period. And here it's just showing you kind of like payroll period ending March 21st. We have those salaries, sales salaries and office salaries for a total payroll of $25,000. And then they tell us those salaries subject to payroll taxes, okay? And then they give us the percentages down here. As you'll see, state unemployment compensation tax is 5.4%, with federal being only 0.8%. Again, we're not going to go into all the nitty-gritty on that. Those amounts can change state by state, company by company, okay? But they're just going to give you the amounts. And then we have employee deductions. They give us the federal and state retirement and charitable contributions. So when we log the entry to pay the employee, so this is the employee entry to pay the paychecks, we always debit the gross pay. So sales salaries expense gross was $20,000, office salaries expense was $5,000. Those are the gross amounts. Then everything gets credited to payable accounts. So these are all payroll liabilities. Because what we're doing is we're taking out Social Security from all of those wages, 25,000 times 6% for 1,500, sorry. Medicare, 25,000 times 1.5%. And then they gave us all four of these withholdings. The reason they're payables is we take them out of the employee's paycheck, and then we're going to pay it to the Social Security office or the IRS and so on and so forth. So when these actually get paid, we would debit the payable and credit cash or whatever, okay? So we're establishing it as a liability though, because we owe this money to these other, well, basically to the government, but also to like a charitable system, the retirement place. So we take the 25,000 gross pay minus all these deductions, and then salaries payable gets credited for the net or the take-home pay. Okay, so the net or the take-home pay gets credited. Let's stop right there and do an example because we're kind of running low on time anyway. So we may do the payroll tax next Tuesday, and that's okay. But let's go ahead and do an example in Cengage on the payroll, journalizing the payroll, okay? This is what we just talked about. Payroll register indicates 3,900 of Social Security withheld and 975 of Medicare tax withheld on total salaries of 65,000 for the period. So they don't even make us calculate much, which is nice. Federal withholding is 14,250. Retirement savings were 2,600. So here we are doing the journal entry for payroll. So what amount would I debit? The what? Salaries expense gets debited. Good. For how much? How much is our salaries expense? It is. Very good. It's the 65,000. It's the gross amount. Okay, so we always debit salaries expense or, you know, wages expense for the gross pay. That's the total expense. Then we just need to go in and credit all of the payable accounts, all the withholdings, okay? So the first one, we would have like Social Security tax payable. Make sure you choose the payable. And they gave us that amount, 3,900 credit. 3,900 credit. Next, we would do Medicare tax payable, which again they gave us 975 credit. 975 credit. We have employee federal income tax payable. So employees federal income tax payable. And they told us that was 14,250 credit, 14,250. They also told us we had a retirement savings. So you'll see retirement savings deductions payable, and that is $2,600. So these are all payables. There's only 4 withholdings on this payroll. So total salaries, expenses, the gross pay, minus all the deductions, what does that equal? So that's my gross pay minus all of my deductions.
43,275.
Very good, 43,275. And what does that represent? What does that mean? The take-home pay. Very good. And also we will log it as salaries payable. So that 43,275 is the checks that we're writing to our employees for their take-home pay. So salaries payable gets credited 43,275. And then when we go cut the checks, we're going to debit salary payable and credit cash for 43,275. There'll obviously be several checks, but that's kind of how that works. Okay. Any questions on that? Okay. I think I'm going to stop right there because I don't think we'll have time to really get any further. But to wrap up this chapter, we're just going to look at, next Tuesday, we'll look at the payroll tax liability. So we'll look at what the employer has to pay, and then we'll do installment notes.